You're watching the Bank of Canada's governor speak on January 29, 2026, and what he said should make anyone who cares about their savings and daily life sit up straight. Tiff Malam's voice is calm, careful, and precise, but the reality behind his words is anything but calm. Most people think central bank announcements are about interest rates, inflation, or minor economic adjustments. That's what the headlines focus on. But in reality, what Malam was signaling is broader, a period of heightened uncertainty in global trade, supply chains, and financial stability. If you live in Toronto, New York, or Houston, or anywhere tied to global trade, this affects you. Your job, your retirement accounts, and even the groceries you buy could feel the ripple effects. Understanding the situation now could help you prepare. Here's what's happening behind the headlines. You saw a governor giving measured statements about uncertainty and risk. What you didn't see is the context that makes those words urgent. Start with trade. Canada and the United States share one of the world's most integrated trading relationships. Every day, billions of dollars in goods move across the border. Automotive parts, energy, agricultural products, and manufactured goods are all part of a system that has developed over decades. A car rolling off a line in Detroit might include steel, aluminum, or components that cross the border multiple times during production. Supply chains on both sides are intertwined. Energy is another major connection. Canada supplies a significant portion of U.S. crude oil imports, and electricity grids in some regions are connected across the border. Aluminum, steel, and other raw materials flow both ways. These relationships make both economies stronger, but also more sensitive to disruptions. Central banks are watching these risks carefully. When a governor talks about unusual potential for new shocks or elevated geopolitical risks, it's more than bureaucratic jargon. It's a warning that standard economic models, which assume stability, may no longer fully apply. In other words, the tools central banks usually rely on may not be enough to prevent disruption. One area of concern is trade uncertainty. In recent years, tariffs and trade disputes have created instability. While some headlines exaggerate individual events, the cumulative effect of uncertainty is real. Companies delay investment, supply chains get cautious, and the cost of goods can rise even without new tariffs being implemented. This is the subtle, slow-moving shock that most people don't notice until prices start creeping up in their daily lives. Another risk highlighted by central bankers is monetary policy uncertainty. Central banks like the Bank of Canada and the U.S. Federal Reserve work to provide predictability, clear communication, consistent policy, and a framework that markets can rely on. When central banks signal that risks are hard to quantify, or when global developments make forecasts less reliable, investors respond. They may move funds, hedge risks, or favor assets that are perceived as safer. This is where gold and silver come in. When confidence in traditional currencies wavers, even slightly, precious metals tend to attract attention. Unlike dollars, euros, or other fiat currencies, they are physical assets that do not rely on central bank policies to retain value. That doesn't mean everyone should buy metals indiscriminately, but it explains why demand tends to rise when uncertainty is elevated. Let's connect these risks to everyday life. If you work in manufacturing, construction, energy, or agriculture, disruptions in trade or supply chains can directly impact your work. Delays in imports or exports can lead to slower production, tighter inventory, and in some cases, layoffs or reduced hours. Even if you're not in those industries, you feel the effects indirectly. Central banks try to manage inflation through interest rates, but sudden supply shocks or unexpected cost increases can make their job harder. That can translate into higher prices for gasoline, electricity, groceries, and consumer goods. When the governor says there's no easy way to manage this uncertainty, it's because these pressures are interconnected and complex. One area where the Bank of Canada and global economists are paying close attention is the stability of the U.S. dollar. The U.S. dollar serves as the world's primary reserve currency, which means many international transactions are conducted in dollars. This gives the United States unique advantages, such as lower borrowing costs and deep, liquid financial markets. But this system depends on trust and predictability. If policy suddenly becomes unpredictable or if trade disruptions escalate, confidence in the currency can fluctuate. Investors respond to this in cautious ways. They may diversify holdings, hedge currency risk, or favor tangible assets like gold. Again, this doesn't mean the dollar is collapsing, but it does mean that financial behavior can shift quickly when uncertainty rises. Another factor is global cooperation, or the lack of it. When countries face trade or geopolitical tensions, central banks and governments must adapt. They can work together to manage disruptions, stabilize markets, or provide support to industries. Conversely, uncoordinated actions or abrupt policy changes can magnify instability. This is why central bank warnings about elevated geopolitical risk are so important. They reflect not just local economic conditions, but how global interactions can amplify uncertainty. It's also critical to understand the role of communication. Central banks spend years cultivating credibility. Every word from a governor is carefully chosen because markets respond quickly to statements about risk. When a governor says they cannot assign probabilities to certain risks, it signals a level of complexity and unpredictability that goes beyond normal economic forecasts. Investors, companies, and governments take notice. All of this connects to your financial decisions. Diversification is key. Avoid relying entirely on a single sector, supply chain, or currency. Consider a mix of assets that can withstand shocks, some cash reserves, some equities, and possibly a portion in commodities that are less dependent on policy changes. Planning for contingencies rather than reacting after a crisis hits is what can protect savings and investments. Let's also touch on trade diversification. Canada and many other countries have recognized that relying heavily on a single trading partner can increase vulnerability. Expanding trade relationships across multiple regions, including Europe, Asia-Pacific, and other markets, is a measured way to reduce exposure to shocks. This doesn't happen overnight, but it is a long-term strategy to protect economic stability. Energy markets are another example. Supply disruptions, price volatility, and changes in regulations can impact everyday life quickly. Heating costs, gasoline prices, and electricity bills can rise even without a direct tariff or policy change. Understanding how interconnected the global energy market is helps explain why prices can shift rapidly. For individual investors and consumers, paying attention to macro trends is as important as tracking personal budgets. Interest rates, inflation, currency fluctuations, and trade developments all interact. For example, even small disruptions in global supply chains can affect prices of cars, electronics, and groceries. While central banks work to stabilize these effects, they cannot fully insulate individuals from every ripple in the system. Now, let's focus on the human side of this. Manufacturing workers, farmers, energy sector employees, and construction professionals are all directly affected when supply chains experience stress. Layoffs, reduced hours, or increased costs of materials can impact entire communities. That's why central bank warnings about risk aren't abstract. They are indicators of potential real-world impact. Even in everyday life, consumers feel it. When costs rise in essential goods, discretionary income shrinks. Families may cut back on spending, postpone purchases, or face tighter household budgets. Businesses may delay expansion or investment, further slowing economic activity. These are the invisible effects of uncertainty: gradual, cumulative, and sometimes sudden. This brings us back to M. Lamb's core message. Preparedness is critical. He isn't calling for panic. He's signaling that conventional assumptions about stability and predictability are less reliable. That means individuals, businesses, and investors should consider how they might respond to unexpected shocks. Some practical steps: monitor exposure to sectors tied closely to trade, consider financial diversification, and keep some assets in forms that are less dependent on policy or currency shifts. Gold and silver are one example, but other tangible assets, diversified investments, and cash reserves also help mitigate risk. Pay attention to policy developments. Central banks provide signals through speeches, reports, and announcements. Geopolitical events, trade negotiations, and market reactions all interact with domestic economic conditions. Being informed allows for proactive planning rather than reactive scrambling. It's also worth noting that while uncertainty can be stressful, it's not the same as collapse. Economies are resilient, and many systems have safeguards. The key is understanding where vulnerabilities exist and preparing accordingly. That way, when disruptions occur, the impact can be minimized. Supply chains, trade relations, and monetary systems are complex. One small change in policy or a shift in market confidence can create ripple effects. But history shows that proactive planning, diversification, and awareness allow both individuals and economies to adapt successfully. Even in uncertain times, there are opportunities. Investors can identify undervalued assets, businesses can adjust strategies, and individuals can make informed choices about savings and expenditures. The goal is not to predict every event, but to understand the environment and respond wisely. Remember, this is a period of elevated uncertainty, not inevitable crisis. Central banks are alert, policies are being monitored, and economic fundamentals remain in place. What has changed is the recognition that risks can appear faster and interact more intensely than in previous decades. For your personal finances, that means paying attention, staying informed, and considering strategies that reduce exposure to shocks. Diversification, contingency planning, and thoughtful allocation of resources are key. Gold and silver, for example, have historically served as a hedge against uncertainty. They are tangible, finite assets that do not rely on policy decisions or central bank interventions. That's why demand often rises when markets or currencies are perceived as unstable. Energy and consumer prices are another area to watch. Supply chain stress can translate into higher bills for everyday items. Even when central banks work to control inflation, external factors like trade disruptions or energy volatility can push costs higher. Being aware of these trends allows households and businesses to make smarter choices. Finally, the overarching lesson is clear. Assumptions about stability are less reliable than they once were. Global economies are interconnected. Policies, geopolitical events, and market confidence all interact. Central bank statements about elevated risks are a signal to pay attention, prepare, and adjust. This is not about panic. It's about clarity. It's about understanding the environment in which your money, your career, and your daily life operate. Those who plan thoughtfully, diversify intelligently, and remain alert to changes will be better positioned to weather uncertainty. In short, global economic stability exists, but the rules are evolving. Trust is critical, preparation is essential, and awareness is your best tool. Watch trade developments, pay attention to supply chains, monitor policy, and consider assets that are resilient to disruption. That's how you stay ahead, not by following panic, but by acting with insight.